All right, Tanya, I don't think I was sharing my noise or my computer sound, but there's the disclaimer. Welcome out, ladies and gentlemen, to YouTube, tackletrading.com. Got a special session tonight for you. This is Coach Tyler. Thrilled to be here. Looks like I'm Noah on Zoom, so let me switch that out here. I could do a good Noah, I think. It is, I mean, he is irreplaceable though. So I'll be Tyler tonight. Let me log into YouTube to see all the comments so we can have a good productive discussion here. I'm pretty excited about this topic. Pretty excited about the topic, how to build an investment portfolio. How to build an investment portfolio. I've been thinking on this one for a while. And I'm going to kind of tell you what prompted this. All right, I've got myself muted. Bharat, hello, hello. We got Amit here. Hello, Micah. Okay, so here's the topic. For those of you that might be joining for the first time, welcome aboard. I'm going to educate you tonight and give you a little sneak peek of something that's coming down the pike in the next Trading Justice newsletter. We're going to be exploring a lot of investing and trading concepts that we teach over at Tackle Trading. So this will give you a nice little taste of the type of education and training that we have at tackletrading.com. So I get the opportunity every once in a while to write the Trading Justice newsletter. And last month, you can find this at tradingjustice.com, but last month we wrote one on beta weighted delta and how to manage a portfolio. For December's newsletter, the topic is going to be how to build an investment portfolio. And so to prepare myself for that, to collect my thoughts, I wanted to do a special little YouTube video, an hour long, giving you all of my thoughts. I'm going to put all the thoughts to paper and help you see logically how I answer the question. Hey, Tyler, I've got some money. I want to invest. How do I go about building a portfolio? There's not one right way to do it. I think there's definitely some best practices. There's some pros and cons given what we have available in the investing landscape here in 2020. So ultimately, you will leave this discussion with a better idea of what an investment portfolio looks like. You will leave this discussion better equipped to make decisions about where to put your money and simply to understand maybe the trade-offs of investing in different asset classes, okay? I'm also going to share with you what I think is the proper way to think through what stocks to buy, why you would buy those, what are the bets that you're making. So this is not something, for those of you that have been at Tackle for a while, this is not something that I think I've explained from this perspective before. So even if you've heard me teach a gajillion times, you'll probably take away something new from tonight. Bharat, you are correct. I do look a little different. I got a new edition. This month. Mariana, good to see you as well. All right, let's get cracking. So here's the question, and I think I'm zoomed in enough, so hopefully you can see that. But so here's the question. I have, I don't know, X dollars, and I want to invest to grow my money. Okay, how do I do that? Or what's a smart way to do that? Okay. I don't care if it's $5,000 or $20,000 or $200,000. It's really irrelevant. These techniques can be used for really any amount of money. Okay. Context matters to me. The challenge with talking about trading and investing is you have different people and different situations. You have different time horizons. You have different personalities and risk tolerances. So it's kind of challenging to have a discussion and get everybody on the same page. So there are a couple very important, not necessarily prerequisites, but things that I want to mention that are relevant to this discussion, okay? So first of all, I'm not talking about wanting to be a speculator guessing if the market's going to go up or down tomorrow. I'm also not really talking about trying to pick which stock is going to go up the most over the next 10 years. Okay. What I'm talking about is I have a long-term time horizon and I want to build a smart long-term portfolio. Okay. A smart, maybe well-diversified long-term portfolio to grow my wealth. Okay. To grow my wealth. So you say, all right, well, how, what are my choices? Could I put my money in cash? Sure, I could put my money in cash. The pro is it's liquid, it's safe, okay? It's always going to be there. The con is inflation and a lack of growth, right? I haven't checked in the last couple of months, but last time I checked, I believe you could get in a high yield savings account. I think you could get around 0.6%. Okay. So around half of 1%. It's very, very hard to get excited about cash as an investment because you're just not getting compensated. You're not getting any kind of return. So, okay, what else could I invest in? What are my other asset class choices? That's really what we're getting at here. I could invest in bonds. I could become a bank or a lender and lend money to the government or to corporations or municipalities and get paid a little bit of interest, right? So the pro with bonds is they're perceived as less risky than stocks, right? And by risky, I mean they're less volatile. What else? Let's just go straight to the con. The con is you have very low return, right? Lower returns than stocks. Okay, lower return than stocks. Well, maybe I could buy real estate. Right? Maybe I could add real estate to this portfolio. Yeah, you could do that. Okay, so the challenge for real estate is if you're going to go buy a house. It's like, how do I invest in a liquid instrument that I can put or maybe add money to every month or every year? If I go buy a rental property in my neighborhood or my city, then I'm susceptible to the local economy and how that's going, right? I got to get a big down payment. There's renters that I have to deal with. Got to be a landlord. I personally think owning physical real estate it has challenges. Definitely has advantages, okay, but it has challenges. I can't really add $100 to my real estate investment every month. You can't dollar cost average into real estate when it costs a big chunk of money every time you're going to buy a different property. So Wall Street's come up with a solution to that. And that is, if you want to access real estate as an asset class, you can use a real estate investment trust. Real estate investment trust, otherwise known as a REIT. So this would be if I am a money manager, if you come to me and I'm investing your money, if I was a financial advisor, for example, I would say, okay, we're not going to buy a property. We're not going to go buy land. We're going to buy a REIT. This is Wall Street's tool or vehicle for access to a broadly diversified basket of companies that are exposed to real estate. So if the real estate market does well, REITs tend to do well. If real estate stinks, REITs tend to go down. And instead of getting paid through rent, you're getting paid through dividends, right? So if you want some exposure to real estate in a portfolio, I would use something like a REIT, okay? And so that would be, there's a lot of them out there. V&Q is the Vanguard one. IYR is a little more liquid. USRT is an iShares REIT. That's another category we could get exposure to. But I got to be honest, the one that I'm the most excited for is the one that's gone up the most in the long run, okay? There is a book called Stocks for the Long Run by Jeremy Siegel. And it is essentially the Bible, like the authority, the go-to source if you want all sorts of data on why stocks are such a good investment in the long run, right? So if you said, hey, somebody make the case for me as to how stocks have performed compared to all the other asset classes, why are they such an attractive vehicle? This is the book I would recommend. Okay. Stocks for the Long Run by Jeremy Siegel. And it makes the case, but ultimately, you don't really have to take my word for it. I don't have to convince you. If you look over the last 15, 20, 50, 100, 200 years, no asset class comes close to stocks in growing wealth. Okay. So if you said, if I went back 20 years ago, 30 years ago, 50 years ago, 100 years ago, and I invested a big lump sum of money, and then I was able to fast forward to today, what investment would have grown that money the most? Okay. The answer is the stock market. The answer is stocks. Okay. And so what is the advantage of the stock market? What is the advantage of owning stocks or equities, they're sometimes called? The answer is, number one, they are liquid. And number two, they have the highest growth rate historically of all the major investable asset classes. Bar none. Okay. So in my portfolio, I want to have some exposure. Probably, I don't know if it's going to be all of these. It could be all of these. I could create a portfolio that's a basket of all of them. Got some stocks, got some real estate, got some bonds, got some cash. You could certainly do that. Okay. And it's really going to come down to, what is your risk tolerance? What is your risk tolerance, or what is your investment objective? Okay. Those are two things that you'll hear a lot when it comes to building a portfolio. What is a person's risk tolerance? What is a person's investment objective? It does you no good to put all your money in the stock market if you're not willing to see your account value go down 5%, because the stock market's volatile. If you were to highlight the con of this asset class, it's volatile. It could be scary. Okay. And so you don't want to set yourself up for sabotage. Okay. Last thing you want to do is put all your money in the stock market. Again, if in a month the market goes down 10%, you're going to bail and sell everything. Okay. You have to be willing to stomach some volatility if you're going to invest in the stock market. Okay. So risk tolerance is key. And then the other thing is like investment objective. So if you say, hey, to reach my goals, I just need to grow my money by 4% a year, on average, versus somebody who says, hey, I need to buy something that has the potential to grow my money at 8% a year. And let me make this even more extreme. Let's say 3% versus 8%. Well, look, I mean, somebody who only needs to grow their money by 3% a year probably does not need a 100% stock portfolio. It's too much risk. It's unnecessary, right? And then somebody says, hey, I really need to invest in stuff that historically has the chance to give me an 8% return. It ain't bonds. It ain't cash. You're going to have to buy stocks to some degree. A large portion of your portfolio is going to need to be in stocks. So that's going to influence what kind of portfolio you build. Okay. And again, the risk tolerance, is it low versus is it high? Okay. So those are two considerations. So when you look at like the best practices or conventional wisdom, what are the tools for building a portfolio? Okay. And I'm going to go to a website that there's a lot of different websites you could use. Okay. They all are similar in the theory or the algorithms they use to construct a portfolio. Okay. And let me kind of explain why I want to start at this place. Okay. I want to start at this place. First of all, a lot of people, when they enter the stock market, they say, okay, I have $10,000 cash. What do I invest in? Right? What do I buy? What do I buy? And I think it's very hard if you start from a 100% cash position as your baseline. Okay. If you say, I have $10,000 cash, should I buy it, buy Apple? Should I swing trade it? Should I do covered calls? What should I do? One of the things I'm going to suggest is don't assume $10,000 cash is the alternative to whatever stocks you pick. In other words, A, I keep all my money in $10,000 cash, or B, I go buy a bunch of random stocks, right? And that's the way I build my investment portfolio. Instead, what I think I would do is I would say, well, what does like a conventional long-term broadly diversified portfolio look like? Let that be the baseline. And then the question is, do you want to deviate from that? Okay, do you want to deviate from that? And let me tell you why I think that's important. In fact, it will become apparent as we go through this. So this is iShares. iShares is an asset manager. Not iShares, sorry. BlackRock is the asset manager. iShares is kind of their type of ETF, or really the marketing name of these ETFs. But basically, this is a tool where you could say, hey, if I want to build an investment portfolio and I was aggressive, what would that look like? What would that look like? Okay. And you could see, okay, conventional wisdom, this gives you a sense of the logic or the thinking behind, if you went to a financial planner, how would they construct a portfolio? Okay. If you say, hey, I'm super aggressive, they say, okay, we're going to put you 100% stocks. Okay. We don't think you need to own bonds because you're aggressive. And adding bonds to the portfolio is not going to increase the potential return, because historically stocks have gone up more than bonds. The only reason we're going to add bonds is if you need some more safety or less risk. And so they say, all right, so here's a 100% stock portfolio, and we wouldn't put this. Let's see, if I'm going to have a 100% stock portfolio, what stocks do I own? 100% stock portfolio. Okay. Could I just buy Apple and say, Apple is my 100% stock portfolio? Sure, you could do that. Okay. It's quite risky because you're putting it all in one company. Okay. So it would be safer, more diversified if you bought Apple and, I don't know, Carnival Cruise Line. Okay. And Amazon and Ford and Walmart and Pfizer and Verizon. Right. So the more diversified you get, obviously, the less risky it becomes. Right. Well, if you look at the iShares example, they're not buying individual stocks. They're buying ETFs, exchange traded funds. They're buying baskets of stocks. Okay. If you say, look, I'm going to buy Apple, you are not investing. You are speculating. Okay. So if you say, I want to buy stocks as an asset class, buying Apple does not do that. Okay. If you buy one stock, you're not essentially guaranteeing you get what the stock market gives. You're speculating. Okay. So buying one stock instead of buying the entire quote stock market is speculating. It's an implicit bet that particular stock will do better than the rest of the stock market or the entire stock market. Okay. So Apple is not the stock market. Buying Apple does not get you full exposure, or it's not an effective vehicle to buy the quote unquote stock market. You're speculating that Apple's going to do better than the quote unquote stock market. So how do you buy the quote unquote stock market? How do you invest in stocks as an asset class and guarantee that you get what the stock market's willing to give? Answer: you buy a globally diversified portfolio. You buy everything. You buy everything. When you look historically and you hear quotes like stocks have gone up, 8% to 10% since 1926, or since, whatever you want to start the date. Okay. What does that mean? Does that mean that GE has gone up 8 to 10%? Does that mean that Pepsi has gone up 8 to 10%? Does that mean that Apple has gone up 8 to 10%? No, it means that stocks, the entire asset class, has gone up 8 to 10%. And typically, they're using something like the S&P 500, right? Or the Dow Jones Industrial Average as the barometer or benchmark or vehicle that represents stocks as an asset class. Okay. And so if you want to get what the stock market is designed to give, and just as a disclaimer, I don't know what it's going to do in the future. 8 to 10%, that's past performance. I don't know what the future performance is. Okay. But all I know is for you to get what the market gave over the last 10, 15, 20, 30, 40, 50 years, you buy an index, you buy an ETF, you buy the entire market, not an individual stock. Okay. And so some people inadvertently buy individual companies thinking they're invested in the stock market or they're buying stocks as an asset class. And the reality is they're not. Okay. They're speculating that whatever company they bought is going to do better than, in this case, the S&P 500, better than the Dow Jones Industrial Average. So you'll notice that this hypothetical portfolio that represents an aggressive allocation does not include one individual stock. No, they're basically saying, okay, put 32% of the portfolio in the S&P 500, put 15% of the portfolio in mid caps, put 4% of the portfolio in small caps. So there's US stocks. You got a nice little diversified US stock portfolio. Okay. And they even threw in some real estate. Say, okay, well, we'll give you a 6% kicker for real estate. But are they all US? No, they said, let's also put 33% in the MSCI EAFE ETF. EAFE stands for Europe, Australasia, Far East. Okay. So that's like foreign developed stocks. And then you've got 10% in emerging markets, which is like China, Brazil, Russia, India, areas like that. Okay. So, and you can look and you can say, okay, so this is my exposure. I'm broadly, globally diversified. These are my sectors. I've got technology, financial, discretionary, industrial. I got everything. Okay. And there you go. Okay. So that is an all stock, globally diversified portfolio. Okay. Now, some people will quibble over whether you want more in the US or more in foreign. I don't really care about that at this stage. But fundamentally, this is how an investment advisor might build an all stock portfolio using a globally diversified mix of ETFs. Okay. Now, if that is my baseline, then my $10,000 is not in cash. It's in a globally diversified stock portfolio. Okay. Such as, S&P 500, if I want to just keep it simple and use one. Okay. So the question in my mind is not, I have $10,000 in cash. I guess what I need to do is pick individual stocks and try to invest that somehow. And now I got to rely on my skill set to know what stocks to buy and in what quantities. You don't need to do that. You don't need to reinvent the wheel. Okay. You could just buy a globally diversified portfolio of the asset classes that you want. Again, buying one company is not buying the asset class of stocks. You are speculating that the one company you bought is A, going to be an adequate representation of stocks as an asset class. And B, you are making an implicit bet that that stock you picked is going to do better than the rest of the market. Else, why would you have bought it? Why would you have bought it? So you want to buy stocks, buy stocks. Buy the entire basket. You'll get what the stock market's willing to give. Okay. And that's how stocks as an asset class are measured year to year. Okay. Now, I will hasten to add that I am not necessarily saying never buy individual stocks. What I'm telling you is don't confuse the two. Don't confuse the two. You going and buying United Airlines or Carnival Cruise Lines or Nordstrom's or name your company and putting all your money in that one stock is not investing. It is speculating. Okay, there's a difference. You may or may not get what the stock market gives. You're rolling the dice on that one company. And you may say, well, that's why I don't put all my money in one stock. I put all my money in 15 stocks or 20 stocks. Okay, you've effectively created your own little index. And guess what? The alternative is you could have bought a globally diversified index, like the S&P 500. So you building this self-constructed basket of 15 different companies, whether you know it or not, you are implicitly betting that your 15 stocks is going to do better than stocks as a whole, right? Like the S&P 500. Maybe they will, maybe they won't, okay? Not passing judgment on that. I'm just saying, don't confuse what you are doing, okay? So when I look at somebody who's trying to invest in the stock market, then I don't just say, okay, either it's cash or you pick some individual stocks. No, I say, okay, well, let's compare. This is what your portfolio would look like, or some variation of this, if you were long-term investing in stocks. But instead, I guess you decided to buy these 3 companies. That's your stock portfolio. That's fine, but recognize that the comparison is those 3 individual stocks versus this globally diversified portfolio, okay? And again, I've said this like 300 times now, so hopefully it's sinking in. You buying those 3 companies as opposed to this is because you apparently think those 3 companies is going to be a smarter way of getting access to the stock market, a better way, giving you better returns for less risk, or some combination of all 3, okay? Now, suppose you don't want to be 100% stocks, or you don't want to be super aggressive. Well, you can play with this tool. Go to moderate. Okay, go to moderate. And what will you learn? Well, you'll learn that they add bonds in there to make it less aggressive. Okay, so here's a globally diversified portfolio of stocks and bonds. You might say, well, that's, I don't want to just buy and hold the entire stock market. I want to pick stocks. Okay, but the bet that you're making then is you can pick stocks and generate better returns than just buying a globally diversified portfolio, right? And so to me, this is kind of the anchor of a long-term investor. And I think that instead of making the question challenging and saying either I'm all cash or I'm picking stocks with all of my money, there's an in-between there where it's like, okay, well, why don't you have like a core portfolio that's in the asset classes you want? And then if you want to speculate or be more active and take more, maybe be more tactical in the way that you invest that money, great, but recognize that that's where skill enters the equation, right? Like buying the S&P 500, building a globally diversified portfolio doesn't really require a bunch of skill. Anybody can just click a button and do it. So if you say, well, instead of doing that, what I'm going to do is all these other fun things, fine, but recognize that by doing all the active going in and out, you now are going to kind of live and die to a certain extent by your skill set, right? If your timing sucks, if your stock selection sucks, you may in hindsight just say, man, I just should have bought the overall stock market, right? And so one of the things that I look at that reminds me of this is if you look at the stock market right now, we're at an all-time high, okay? What does that mean? That means that people who own the stock market or own a globally diversified portfolio, specifically U.S. stocks, let's be specific. The S&P 500, U.S. stocks are at an all-time high. Okay, not all foreign markets are at all-time highs, but U.S. stocks are at an all-time high. So if I have a U.S. stock portfolio, my account should be at an all-time high. It certainly would be if that's what you owned. You say, well, my account is not at an all-time high. In fact, I've just lost a bunch of money. It's not because you owned U.S. stocks in a broadly diversified account, because if you did, you would be at an all-time high, right? It must mean you deviated from the performance of the market because whatever stocks you picked and whatever active tactical trading you're doing is underperforming, right? You're not only not doing better than buying the entire market, you're not even doing the same. You're doing worse. Right? Now, does that mean don't actively trade anymore? No, not necessarily. Maybe you're just still in the learning stages. I'm just saying the alternative to actively trading and doing these strategies is not being in cash, I would view the alternative as owning a globally diversified portfolio of stocks. Because if I earmark and I say, look, I'm either going to put this money in the quote unquote stock market, or I'm going to actively trade and pick individual stocks. Well, I mean, then by, again, picking the individual stocks, you're kind of assuming you're going to do better than the alternative, which is owning the S&P 500. So something to think about. It's something that I've thought about over the last 15 years or so as I've been trading. Okay, so when I look back, I say, okay, I learned about the stock market and how to invest in 2006. Okay, so this is when Tyler was born as a trader, right? He got exposure to the stock market, started teaching people about the stock market. And over my career of doing that, what have I seen the stock market do? Well, by and large, it's gone up like a lot, right? So if I bought the quote unquote stock market, if I bought the US stock market, which quite frankly, somewhat, somewhere around, I don't know, 50%, probably more than that. It's got to be around 50% of the revenue or the sales of the companies in the S&P 500 comes from overseas anyways. So yes, these are US companies, but that doesn't mean that you're only exposed to the US economy, right? Like the S&P 500 might as well be a global stock ETF at this point, right? And so what have I seen? Well, I've seen the global stock market go up and up and up and up and up and up and up. And so, back then I was 21, now I'm 36, and I am much more interested / confident that in just the upward mobility of the stock market over time, and then perhaps I was when I first started because I had no experience, right? You might say, well, isn't this an aberration? Like, maybe it's just the last 15 years that the stock market does this. If you looked at prior 15-year periods, it wouldn't have been, it would have been lower 15 years out. Look, that's happened maybe once or twice in history, but by and large, the market does tend to go up over time. And the best, I don't want to say best, the most efficient, least risky, least skill-based way of getting exposure to the stock market is through a broad-based basket, an ETF. Okay. Now, I think I've sufficiently said the same thing 25 different times, and I've made my point. Okay. Hopefully I've made the point. So just understand that if you're going to, I'm going to say it again. I'm done. I'm done with that one. I'm done with that one. Let me double check the comments here and see if there's any questions that I did not get to just yet. Let's see. I think aggressive is the way to do it. The market has historically recovered within 18 months after corrections. Yeah. So how would somebody know? How would somebody know if owning an all stock portfolio is appropriate? Do you know what I would do to think through it? Is I'd say, okay, what I would do is I would, let's say it's $10,000 in an all stock portfolio. Okay. And to keep it simple, let's say it's the S&P 500. Okay. Well, I would look historically and I'd say, what's the worst that could happen, right? Like what's a typical bear market? And the answer is, the worst that could happen, you've seen a couple times where the market's down about 50%, a little bit more than 50%. So on $10,000, that would be a $5,000 loss. So if somebody said, look, I wouldn't panic. I'd be okay with that. Look, if you can handle your investment portfolio getting cut in half, then you probably have the emotional disposition to handle an all stock portfolio, right? But if you said, look, if this investment got cut in half, I would puke. I would sell everything. Look, it doesn't happen that often, but just know that's what you're signing up for. That's the nature of the beast, right? And so I would get a sense of what are the drawdowns, right? And one way to do this is to look at just a long-term chart, right? So I could say, all right, well, let's look at SPX. From peak to trough here, we were down, 30 30+%, right, in March. Okay, in 2008, we were down like 50%. In 2000 to 2002, we were down like 50%. I could just go back and look at every previous correction, or I mean, if you wanted to do it manually, you could, or you could, quite frankly, just Google it. There's lots of resources that'll tell you the average correction in the market. But basically, I just make sure I'm comfortable with the typical volatility. And if once to twice a decade, I can handle my portfolio getting smacked by 30% or something, yeah, you're probably fine. You're probably fine, right? And I think too, it depends on how much capital you have. 30% drawdown when you have $10,000 doesn't hurt as bad as when you have 100,000 or 200,000 or $1 million or 5 million or 10 million. You just got to look at what would a bear market do to my portfolio. Can I handle that? If you can't, then you don't want to be in an all stock portfolio, right? You want to be in something less aggressive. Generally, the younger you are, they say, the more aggressive people tend to be, but not always, So, Ahmad, I'm with you there. Good question. In regards to, with real estate, you're able to use leverage. When you're using leverage, it's obviously it accentuates the returns, right? But you can use leverage in the stock market too. So when we say that stocks historically have gone up more than real estate, I'm not accounting for leverage. Saying if you put $100,000 in a house 10 years ago versus $100,000 in the stock market 10 years ago, or 50 years ago, or 100 years ago, and you look at how the house has gone up in value, how your $100,000 has gone up in value versus the $100,000 in the stock market, over a long period of time, the stock market goes up more. Now, if you say, well, I would use a ton of leverage in real estate, well, then that's not a fair comparison. You can't compare levering up and putting $100,000 but buying $1 million house to just $100,000 in stocks, because it's unfair, right? And using the leverage for real estate involves a greater degree of risk. And so when it's apples to apples, when you look at a non-leveraged investment in real estate versus a non-leveraged investment in stocks as an asset class, stocks win. They win. Okay. Now, I fear that I may have bored you to death with my little monologue there on building an investment portfolio. Okay. Let me get into the weeds a little bit. Okay. Let me get into the weeds a little bit. Say, okay, so status quo here. Step one is, let's say that status quo is I have a diversified all stock portfolio. Okay. Now, the question is, why would I deviate from that? Assuming I'm comfortable with it, assuming that I have, again, the risk tolerance and the time horizon to make an all-stock portfolio work. I can think of a couple reasons why I would deviate from that. Okay. Number one, I might say because I think, or I've learned strategies that outperform buy and hold, right? I've learned strategies that outperform that. And so money goes where it's treated best. Money goes where it's treated best. It doesn't like to be, it's like a person. People go where they're treated best. If you treat somebody like dirt, they're going to go away, right? So if I say, look, I've got this stock portfolio, and how much has it grown over the last 10 years? Well, how much has the S&P 500 grown over the last 10 years? How much has the S&P 500 grown over the last 10 years? I don't know. Let's look it up. I don't know off the top of my head. Annual return of S&P 500. Annual return of the S&P 500, and right here. Let's go here. Business Insider, and they got the answer. The average stock market return for 10 years is 9.2%. That's 9.2% per year, not for the whole 10 years. Okay. for the past 140 years, according to Goldman Sachs. What about 2010 to 2020, just the last decade? The S&P 500, which you can invest directly in using IVV or SPY or SPLG or any number of other S&P large cap ETFs, has done slightly better than that with an average annual return of 13.6%. Okay. Now, it's not like a straight line like this. It's up 13, it's up 13, it's up 13, it's up 13. Okay. It fluctuates quite a bit. It fluctuates quite a bit, but that's the average. That's the average. Okay. So what's the point? Well, so this is nice. This is nice. Here's the last 10 years. Okay. Now, if I could redo this, I would have asked you first what your guess was. Isn't this pretty impressive? Stocks as an asset class that you could get exposure to by buying something like the S&P 500. They went up 15% in 2010. They went up 2% in 2011. They went up 16% in 2012. People are like, hey, great. 2 out of 3 of the last years were up double digits. And then the market's like, I'll do you one better. And it went up 30%, 32% in 2013. When did we go down? Oh, you had one down year. How pathetic. It went down 4.4% in 2018. What a loser. What a loser. It went down 4.4%. But I don't know, 9 out of 10 seems pretty darn good to me. 3 of the last 10 years, we were up over 20% in a single year. That's pretty darn impressive. Now, is the last 10 years typical? No, I already told you that. If the average annual return is 9.2, and over the last 10 years, we've done 13.6, then the last 10 years have been above average. They've been above average. Okay. Okay. So if you had signed up and said, give me whatever the stock market's willing to give, just give me America. I just want to buy America. I want to buy the top 500 companies, which effectively give me exposure to stocks as an asset class. You did that in 2010. What do you got 10 years later? You got like a 13.5% return on average per year. That's pretty dang good. Got to be honest. Pretty darn good. So why in the heck would I deviate from that? Why wouldn't I just buy the S&P 500? Okay. And by the way, I am quite confident if I were to make a bet, if I were to forecast, make a projection, just pull a number out of my hat, I'm pretty confident in saying no way, no how we keep going up 13.6% a year. Okay. I do not think you can take the last decade and then just project it out every decade from here on out. It ain't going to be that good, in my opinion. Okay. I think, we'll eventually go back to whatever the historical average is over long periods of time. All right. But even still, even if we looked at the last 10 years and it had gone up 8% on average per year or 7% on average per year, do you know what? That's probably better than what real estate did. It's probably better than what bonds did. And it is certainly better than what cash did. Okay. So again, I asked the question, why would I deviate from that? Well, number one, maybe you've learned a strategy that you believe outperforms buy and hold. And more than belief, maybe it's something you've been trading and you have the experience and the track record to back it up. And so you're like, well, A, I could buy S&P 500 and sit on it. Or B, I could do my whiz-bang strategy, whatever it is. Maybe it's selling covered calls. Maybe it's some kind of naked put strategy. Maybe you're swing trading or picking individual stocks. Okay. The alternative to whatever whiz-bang strategy you're playing with, in my mind, is not cash. It's buying stocks as an asset class. And so whether you've consciously made that decision or not, you have to realize that in engaging in whatever stock picking / option selling strategy you're doing, you are implicitly betting that it's going to do better than buying the S&P 500 or some equivalent. Okay. And if you don't really believe that, or it's consistently doing worse, you do kind of have this awakening where you say, I wonder if I want to keep doing this, or maybe dial back a little bit, right? So again, could be because your strategy you think does better. It could be because I can't handle an unprotected 100% stock portfolio. So I have to reduce risk somehow. Got to reduce risk somehow. And, I could just buy bonds or maybe just have 70% stocks, 30% bonds, or 50% stocks, 50% bonds, or 50% stocks, 50% cash for that matter. Okay. And so the conventional answer would be maybe you up your allocation to to cash or bonds, right? Or in your case, maybe say, no, what I do is I buy, some kind of insurance on my portfolio. Like in the field of tackle trading, I'm thinking like the Bear Market Survival Guide, which teaches you about how to buy portfolio protection, right? Or you could say, look, by being tactical, by getting in and out, by using stop losses, if the market drops 30%, I know that I'm not going to lose 30% because I don't just sit there as the market crumbles. I get out, right? I'm more tactical. Okay, maybe that's a reason why you deviate from. Okay, maybe that's a reason. Now, you might say, well, hey, I see merit to both, right? I'm with Supreme Vision here. I see merit to both, okay? Why does it have to be all one or all the other? It doesn't. It doesn't, okay? Quite honestly, one reason why people don't just buy stocks as an asset class and keep investing in them is because it's boring. They don't have any cool stories to tell, no conquests to tell the boys about, right? Hey, you getting some Tesla, huh? You've been buying some Bitcoin? Hey, I just own the S&P 500, man. I just buy a little bit every month, right? I mean, that's not that fun. That's boring. I need some excitement in my life. So, all right, I want to speculate with a little bit of my portfolio. Great, do it. And maybe through speculating, you discover, dang, Gina, I got a pretty good, I'm pretty good. Pretty good. I got a good skill set here. Maybe I should allocate a little more money to this. By all means, money goes where it's treated best. And so if you can, if you can show that you've done better than stocks as an asset class, then by all means. If I say, look, I got $30,000 in the S&P over here, and I've been actively trading, doing some strategy, cover calls, options, stocks, whatever. With this $5,000, I'm killing it. And my only problem is I just need more money. I just need to increase the amount that I'm trading. I feel restricted. I feel like if I had 10 or 20 or $30,000, I'd be able to do even better. Okay, well, you got 30,000 over in the S&P 500 right here. It's exposed to stocks. Could you maybe take some money from that and reallocate it to this other whiz-bang strategy that you're doing well with? Yeah, why the heck wouldn't you? Okay, money goes where it's traded best. If you're like, look, I am not impressed by this last 10 years of the S&P 500. I scoff at the average 13% annual return because my whiz-bang strategy is just beats the pants off of that. Yeah, then I don't know why you would buy the S&P 500 other than just for diversification purposes, or maybe because your risk rules don't allow you to put more than a certain amount of money in a strategy. That's the other kind of restricting factor, particularly as your account gets bigger. So you may say, yeah, I got some strategies that I do, but I can't dump too much money in them because it's unwieldy and I just can't handle the losses and the drawdowns. And so I can be aggressive with the smaller portion of my portfolio, but the bigger chunk, I want to be invested in stocks. I want to have exposure to the stock market, but I can't use leverage or do it in a crazy aggressive way. So I'm just passively diversified. Okay. See, I'm with Vision. I think 13% is pretty dang good. Let's be honest. I mean, we live in a world where you're getting zero in the bank right now, right? So your baseline is pretty low. Okay. If we were in a world where you could invest in the bank and get 10% risk-free, you might think that would never happen. I mean, it happened back in 1980s, late 70s. interest rates were through the roof. Okay. There were banks that were probably paying you 13, 14% interest for taking no risk. And back then they would have been like 13% of the stock market. Why the heck would I do that? I can get 30% in the bank. Different world. Your baseline is 0 in the bank. Okay. So, we talk about 5%, 6%, 7%, 8%. You don't even need to get to 13% to intrigue me, because the alternative is zip, zilch, nada. It's a low interest rate world we live with, right? So yes, more than the banks. It's more than the banks. Okay. Now I have a question for you. Are there any other reasons I've left out in terms of why would I deviate from just a all stock diversified portfolio? Because the only reason I can think of, again, is I can do better by being tactical and getting in and out of the market, by picking stocks, by being more active in the way that I trade. Okay, by all means, do it. Or 2, I can't handle all my money in the stock market, because if it goes down too much, then I'm going to panic and sell. Okay, so I want to reduce risk, and I don't want to do it by having a bunch of cash or a bunch of bonds. I want to do it by buying protective puts or something, right? Or I'm bored. I guess 3 would have been bored, right? I'm bored / want some potential home runs. Want some potential home runs, dang it. And you don't get very many home runs in the S&P 500, okay? I like the idea of swinging for the fence every once in a while. Give myself a chance, all right? Give myself a chance. Am I ever going to have a year where I'm up 50% in the S&P 500? I think historically it's happened maybe once, but it's probably not going to happen. So you want some home runs? Yeah, you probably got to switch things up a little bit. Okay. All right. I did not talk about commodities. That is correct. Would the discussion have changed if on the asset class choices I added commodities up here? Gold, silver, that kind of stuff. Have they done better than stocks in the long run? Nope. So the equation wouldn't have changed. The supremacy, let's stick with that. The supremacy of stocks doesn't change. Stocks have gone up far more than gold, far more than silver in the long run. Okay. In the short run, certainly any asset class can beat the others in the short run. But if you're looking over decades, over multi-decade periods, stocks beat the pants off of gold or silver. There is no cash flow in commodities. You don't get paid dividends. You don't get paid interest. The only way you make money is if they go up in value. Okay. And the beautiful thing about stocks is they not only go up in value more than gold and silver, they also pay you dividends. So stocks are like a double whammy, right? Stocks have gone up more than gold and silver, and they've paid you dividends along the way. Okay. They pay you dividends along the way. So if the question is, are commodities better than stocks historically from a performance perspective, the answer is no. If the question is, do they provide a diversification benefit? The answer is of course. So if you look historically, say the last, 20, 30 years, and you say, if I had 5% of the portfolio in gold and silver, would that have provided a little bit more stability and maybe less volatility in an all stock portfolio? The answer is yes, right? So getting the proper mix between how much stocks, how much real estate, how much bonds, how much commodities, you can read reams and reams of data and books about why maybe this mix is a little better and that mix is a little better. The one undeniable fact that you'll discover is your behavior matters more than the exact asset allocation in the portfolio, right? So whether someone wants to have 10% in gold or 5% in gold, I would just go on record saying if somebody wants to have 50% of their portfolio in gold, they're a little loony, to be honest. So I'm talking like a smaller sleeve, but it doesn't matter near as much as, are you saving and investing money? Are you not abandoning your investments when the market goes down and blowing up the portfolio with bad decisions? The decision making and the behavior matter far, far more to your long-term returns than, oh, I had 5% in gold instead of 10% and it killed me, right? I don't think anybody would ever say that. I don't think anybody would ever say that. So it's interesting that we spend a ton of time and attention on, which stock do I buy, or what's the right mix? Should I be 80-20 or 70-30 or 90-10? When in the real world, really what matters more is, are you investing money every year, right? Are you buying when the market's down, even though it's scary? Are you fully funding your retirement accounts and the tax advantaged accounts? Okay. Do you have goals in place and a plan, which is what drives the portfolio that you've constructed? Or are you just trying to guess what the stock market is going to do over the next week? And are you just randomly picking stocks and speculating with, with whatever you're speculating with, right? So, okay. So Ahmad, that's my answer. I personally own gold. Full disclosure, I do own some gold. I do own some silver. So I'm not adamantly opposed to them. I'm just talking. If somebody wants to put all their money in gold and silver, I think they're, like I said, a little cuckoo. I think that it's very hard to make forecasts that don't jive with the long history that we have, right? So for somebody to say, hey, I know stocks have been the best asset class pretty much every decade or every 20, 30 year period over the last forever. But I'm telling you, over the next forever, they're going to suck. It's like, based on what, right? It's a very hard position to take to argue against the totality of history, right? But look, I'm not saying that you shouldn't diversify. I don't mind having a little bit of exposure to any asset class. I just think stocks should be the bulk. I think stocks should be the core. And then you kind of tweak things on the margins around that, because that's how, wealth has been built historically, is by having exposure to the stock market, right? Okay. Yeah, Ahmad, no, it's a great question. I'm glad you answered it. Glad you asked it. Okay. All right. I got 2 more minutes. I will tell you a tackle here in 30 minutes. We're going to do a step system mastermind group meeting. So for those of you guys that have the step system or pro members with access to the step system, I will be launching that webinar here in about 30 minutes. We're going to take a look at some swing trades. And I got a sneak peek. We did our scouting report meeting earlier today and picked the stocks for the report. And I want to run those through step system stuff. So we're going to set up some swing trades, going to look at some targets and entries and stops, and otherwise apply the theory that's in that video series. Okay. All right. So I will save this. Yeah, Ahmad, ask Mark, and then I'll forward it to him, and he can send it to you. So little different angle tonight. Okay. I hope that you found this helpful. Okay. But maybe just a different way to think about how you invest in stocks as an asset class, why you might not build a diversified portfolio, and why you might. Okay. Why you might. So, Ahmad, so the step system, go to tackle trading. Oh, by the way, the Trading Justice newsletter is free. So I am going to write about the concepts that we discussed tonight and more. And to be frank and candid, this was a little bit more of me just thinking out loud, okay, as I was going through tonight. So if it didn't seem fit and polished, you guys were my guinea pigs. Okay. What? I mean, how much did I charge you to be here? Oh, that's right. It was free. Free 99, free. And so you guys were my guinea pigs. I charged you nothing. And I feel like, though, it's been time well spent. All right. I don't want to downplay this too much, but the polished, well thought out version coming in the newsletter, tradingjustice.com, in December. Okay. That'll be the topic, probably with more charts. I think I need some more charts. As far as the mastermind, meaning, so you would have to have access to the step system, Ahmad. So if when you go to Tackle Trading and you log in, if you have access to the courses, if you go to the courses and you go to the step system, you have access to the step system, then you have access to the mastermind group. Okay. If you don't have access to the step system, then you won't have access to the mastermind group. Typically those go hand in hand. Okay. All right. So I'll see you here in about a half an hour. You can see it right there. Step mastermind group. Come hang out. We'll do some swing trading. And I think I noticed we are having some specials going on. It is Thanksgiving and holiday time. So you might see some specials popping up on the website. Take advantage of that. Okay. Thanks for hanging out, guys. Have a happy Thanksgiving, and we'll see you on the inside. Bye-bye.